Today, we're going to talk about what it really means to be wealthy. And I'll tell you, it's probably not what you think. It's almost never that flashy, over-the-top lifestyle you see on TV. So, let's dive in.
So, what does being wealthy actually look like on a normal Tuesday? We're constantly sold this idea of pure flash and extravagance. But the reality? It's something else entirely. It's a lot quieter and way more intentional. Okay, this right here, this perfectly breaks down that huge disconnect. The media, they're always pushing flashy new cars, giant watches, mansions. But the reality of actual wealth, it's a lot quieter. Think an older, reliable car that's completely paid off. It's about that freedom you get from valuing your time and experiences, not just stuff. Honestly, chasing the look of wealth is often the exact trap that stops people from ever building it.
All right, so if it's not about all the flashy toys, what is it about? Well, it really just boils down to a specific way of thinking, a mindset. And we can actually break it down into three core principles. Think of it like a blueprint for building real, lasting financial security. And here they are. Number one, value your time way more than trophies. Number two, master financial discipline. And number three, practice delayed gratification. Now, these aren't about being cheap or restricting yourself. Not at all. It's all about focus. Focusing on what actually builds a life of freedom, not just a life that looks good to the neighbors. So let's dig into that first one.
This first principle, it is an absolute game changer. The people who are truly wealthy, they get it. A car is just a tool. It's a way to get from point A to point B, not some trophy to show off how successful you are. They understand that time is the one currency you can never, ever earn back. And check out this contrast. It's fascinating. You go to certain parts of Miami and the whole culture is dress to impress, right? Brand new cars in pretty much every average driveway. But then you go to some of the wealthiest spots in the Bay Area and you'll see a 15-year-old Toyota parked in front of a $15 million mansion. Why? Because they have absolutely nothing to prove to anyone. And this is the key. They spend their money strategically, not on flashy things that just lose value, but on things that buy back their single most precious asset, their time. So that might mean hiring a gardener or a cleaner or even a chef, anything that frees them up to focus on their health, their family, or their real passions, like art or travel. Okay, so principles 2 and 3 are really intertwined. We're talking about financial discipline and patience, or what people call delayed gratification. It's all about controlling your spending and just getting comfortable with the idea that you don't need to have everything right this second. And believe me, that combo is incredibly powerful. So what does that discipline actually look like in real life? Well, it's about deeply understanding the difference between a want and a need. Someone with this mindset might agonize over a $30 want purchase for a week, but a necessary $20,000 expense, like a new roof, they won't even blink. They steer clear of those buy now, pay later schemes because their logic is simple. If you can't afford it now, you don't buy it now. That, right there, is the power of delayed gratification. Okay, so we've got the mindset down, right? Now, this is where things get really, really interesting. Because this way of thinking, it's not just some secret to getting rich anymore. In the economy we're in today, it's actually becoming a critical survival tool. We need to talk about the reality we're all navigating right now, the K-shaped economy. So, what is a K-shaped recovery? Well, it's pretty much what it sounds like. Imagine the letter K. After some big economic downturn, the wealthy and their assets, they just shoot straight up. That's the top arm of the K. But at the very same time, the middle and lower classes find their finances either stuck in neutral or, worse, heading down. That's the bottom arm. It's two totally different economic realities happening all at once. And honestly, you can see this split everywhere once you know what to look for. Let's just take the airline industry. Airlines are reporting that sales for premium and first-class seats are absolutely soaring. But at the same time, they're seeing a big drop in demand for regular old coach seats. See what's happening? The top of the K is flying first class, and the bottom of the K is staying home. The car market shows this paradox perfectly, too. Get this. According to Cox Automotive, the average price for a brand new car just hit a record high. Who's buying? Mostly wealthier households. But here's the kicker.
In the exact same market, at the exact same time, the number of people defaulting on their car loans is also hitting a record high. It's a crystal clear picture of those two paths just splitting apart.
And in an environment like this, you've got to be aware of a potential trap. When you hear the Federal Reserve talking about cutting interest rates, a lot of us think, oh, great, relief is on the way. But you have to be careful, because sometimes those signals are designed to do one thing: get you to take on more debt and spend more money, often at the absolute worst time.
And that's exactly what this quote is getting at. This is all about making you feel confident enough to go out and sign up for a new car loan or a mortgage. It's a spending trap. And it's one that people with that disciplined, quietly wealthy mindset are basically conditioned to see coming a mile away and avoid. They just see the bigger picture. So here's the big question, right? How can you apply that same blueprint, that same quiet, wealthy mindset to navigate this really challenging K-shaped world? Well, it turns out a lot of people are already doing it. Let's look at one of the most powerful trends that's happening right now, especially with young adults. They are putting these exact principles, delayed gratification, living below your means, into practice, and they might not even consciously realize they're doing it. Check this out. According to Pew Research, a staggering 57% of Americans between 18 and 24 years old are now living at home with their parents. And look, that's not just a feeling. It's a huge, measurable shift. That number is up from 53% back in 1993. And let's be clear, for most of these folks, this isn't some failure to launch story. No, it's a smart, strategic financial move, a direct response to the crazy economic world we live in now. I mean, this quote from a 23-year-old just nails it. They're saving almost $30,000 a year by living at home. They called it a short-term trade-off for longer-term financial stability. That is the literal definition of delayed gratification, right? You're trading a bit of short-term independence for a huge leap forward in your long-term security. See? This is the blueprint in action, right here, right now. By making what is, let's face it, a tough choice to live below their means and be patient, this generation is building a seriously powerful financial foundation. One that can withstand all these economic pressures and, ultimately help them get way ahead of the curve. And all of this brings us full circle, right back to where we started. Being rich, it's not about looking rich. It's about not having to prove a single thing to anyone. It's about the freedom, the security, and that quiet confidence that comes from knowing you're okay without needing anyone else to validate it. So I'm going to leave you with this one final thought to chew on. In a world that seems to be splitting more and more every day, this K-shaped world, maybe the new luxury, the real luxury, isn't a fast car or a fancy watch. Maybe it's just the simple, quiet, powerful freedom to make your own financial choices.